So today we're going to be doing a review of the XRADIng.com hedge fund incubator program. This video is sponsored by our free Golden Time Bomb Expert Advisor. Take your trading to the next level through automating the London breakout and the opening range breakout. Click the link in the description to download the EA completely for free. So XRADIng comes up often, typically in the same vein as iFunds, as an alternative to traditional prop firms. And it's an interesting model because there's a few firms out there which are also acting as leverage providers, similar to prop firms, but instead of making the majority of their P&L from failed challenge fees, they're pretty much modifying the traditional brokerage model in such a way that can favor very successful traders. So let's dive in just to see if this is a good alternative to prop firms, and probably more likely, is it a good addition to prop firms so that we're able to run both and further diversify our potential sources of income. And I quite like these types of firms because it gives us another model which might be potentially even more sustainable than prop firms. I personally believe that prop firms likely are quite sustainable because at a certain point, like we've already seen that rules are getting stricter and prop firms are getting better at hedging. So we know that they're essentially able to meet the liquidity requirements just because they understand how to manage their risk. Like a good caveat is like casinos have been around for a very long time and they're extremely profitable. Yet the casino will actually pay you out if you win money. Granted, the odds are not in your favor and you can't really beat the house and they might throw you out if you're winning too much money too. However, there is a model that actually can work in terms of primarily paying people out from failed challenge fees or from failed gamblers. However, this model is a little bit unique, so I'm curious to dive in and see how it differs, as well as just how their actual revenue model is structured. And here they call it a hedge fund incubator, and pretty much what they do is they have a partnership with brokers, and your money is going to be held at the broker as a deposit. And then based on that, they are essentially giving you buying power as part of their hedge fund incubator. And how this works, and it's similar to iFunds as well, is that they claim that every time you hit a certain profit threshold, they're going to be increasing your capital allocation. And if we actually dive into the math here, we can pull up one of these charts or one of these diagrams, and we can see how that exactly would work. So under their basic one where you deposit $1,000, at first they give you a $9,000 incubator amount and you have a max drawdown of $1,000. So this is similar to iFunds where essentially the prop firm is not really at risk, or the trading incubator is not really at risk, because the max that you can lose is your deposit. So realistically, they're only giving you additional leverage here, and you're just having more buying power because you can lose 100% of your deposit, whereas most brokers would margin call you at 50%, maybe 40%, as you would not be able to support it. So it's just a way that they are essentially taking a little bit more risk and that they won't margin call you as quickly. However, at the same time, they're protected, at least in the first stage, because of the fact that your deposit is equivalent to the total maximum drawdown. And the vast majority of traders, likely 99%, won't make it past this level anyway, because it involves having a 20% profit target with a 10% drawdown. And as we know that from most prop firms, like over 90% of people won't make it. So this is probably kind of how they make their initial view here. Like they're still making money off of the broker, because what they're going to do is they're going to take this $1,000, they're going to lever the crap out of it, and then they're going to make money off of spreads and commissions, essentially as a way to just be an introducing broker. And that would make a lot of sense. So this is a pretty straightforward model, at least level one. Like they're just acting as leverage provider and they're protecting their downside with your deposit. So nothing revolutionary here, similar to the traditional brokerage model. But where it gets interesting is that depending on if you hit your 20% profit targets, they start to actually increase the incubator amount. So they start to say that like, hey, at stage 2, we're adding an additional $10,000, then we're adding an additional $20,000, and we're effectively adding more money to your account once you hit certain profit targets. And the curious thing to do here would be to actually calculate how much money you're making from the leverage here. Because let's say that in reality, this $10,000 is levered up to, this $1,000 is levered up to $10,000. And here you're going to be making a minimum of $2,000 on that $10,000. So you're making $20,000. But in reality, you should have made this money for the broker anyway, because you were just trading. Like, had you been, like, let's say you made $1,000, you put $1,000 into a brokerage account, you turn that into $10,000 with leverage, and then you traded it in such a way where you made $2,000. There should be $2,000 cash, which is ultimately made here. But the main difference is they enable you to get paid out here, and at the same time, they then would fund your next view. So this is kind of the interesting part. I'm not so sure, like, when they pay you out, do you still get the, like, are they copy trading you? Do they still get the allocation? Like, how are they exactly doing the next step? But that's actually kind of interesting, because with a traditional broker, yes, you would have more buying power, but at the same time, you wouldn't necessarily be able to take a payout. So I'd have to double check this, but if you're able to take a payout and at the same time kind of progress to the next level, that's actually pretty interesting. So I'm curious as to how the revenue model works there. Are they copy trading you or hedging you in such a way where they can increase the buffer here? Like, that would be one potential way of doing it. Like, actually making an allocation seems a little bit risky, in my opinion. Like, giving allocations to traders, like, there's not a ton of investor capital behind that. So it's probably still some sort of broker hedging technique. Maybe at a certain level, they are in need kind of on the back end, copying your trades with a higher level, being able to kind of build themselves up an additional buffer. So I'm quite curious as to how that exact model works, because in theory, like, if they weren't doing a profit split and they were just reinvesting, then they would constantly be protecting their static maximum drawdown. And as we can see, the profit split is also going down. So they're able to essentially take the amount of money being generated and apply it towards your account, which then enables them to hedge a percentage of their risk. What I'd be curious to see is, like, how much are they allocating from the profit split, or how much are they allocating from the revenues generated by your trading for them to protect their own downside. So anyway, I won't go that much into detail here, but the key takeaway is that this is actually a pretty interesting approach, because of the fact that you're able to theoretically de-risk your deposit on the first profit split, and then they keep giving you more money. So that's actually pretty interesting. If it works, and if you're able to hit those targets, it does make sense. Because for all intents and purposes here, you as the trader, like, you only care that you get your $1,000 back and you have more buying power. So if you put the $1,000 in and you essentially respect their limitations, you get 1/6 back, and then it grows. So this is actually, it could be a pretty good deal. And effectively here, it's just like nothing out of the ordinary here. They're saying that they're continuously Xing your capital, and your profit split goes down, which makes sense. They need to protect their own balance. You have to apply. No Aussie or US residents are allowed, and they give you actually fairly healthy leverage. So this is actually looking quite interesting. I'd be really curious as to how they're doing it on the back end, because for traders, it seems like a pretty decent deal, in my opinion. However, like, I'd also be very curious to see, like, how exactly are they protecting the risk, and where's the money coming from? And because brokers aren't stupid, they must be finding some way to manage their risk. They must be finding some way to, like, manage liquidity concerns. So I'd be a bit more curious to dive in more depth to see how that's going. But overall, like, based on just us getting paid, this looks like a pretty good option. So I'm going to look at it in more detail and then see if perhaps I can start a challenge. So guys, hope you enjoyed this video. I'll see you in the next one.